Macquarie joins in on the phone line from Hong Kong, where all the action is at this point in time. Victor, it's been a bloodbath across global markets this morning. I mean, China is down almost 8%. How are you reading into the developments that we've had in the last 24 hours, and how should investors position themselves now?
Well, it depends what investors want. If investors are investors, view would be different if they're just traders. In terms of what's happening right now, it's very straightforward. We've been discussing for a while that deflationary pressures globally are rising, and the only way to offset those deflationary pressures is central banks' generated liquidity. There is no global recovery. There is no global growth rates. Velocity of money globally continues to fall. So if you don't stimulate liquidity by the major central banks, if you don't have very proactive fiscal policy, you will end up with deflation. And clearly, as we all know, deflation is not something that particularly emerging market equities like, but the same applies to developed market equities as well. So that's what we're seeing. We're seeing a breakdown in confidence that we actually going to have growth rates, going to have inflation, going to have nominal GDPs as we progress forward. Unless we have a significant shift in a public policy stance, it's going to get worse rather than better.
Okay, Victor, stay on. We're also joined by Arvind of Geosphere Capital Management, and Jeff Dennis of UBS also joins us on the phone line from New York. Good morning, gentlemen, and thanks so much for staying up late at night over there to talk to us. But Arvind, first question to you. How have you read the big collapse that we've seen across global equities and commodities over the last few days, and what's the way forward? Do you expect the current plunge to worsen?
Well, I think that, commodity markets have been in a bear market for a while. So that's not new news. What is new news is the sell-off that we are seeing in equity markets in a much more broader sense, and some of the sectors that were holding up reasonably well are now starting to see a lot of pressure and seeing significant sell-off. So I think that the problem is that when China did its currency adjustment downward, that set in stage concern both about China growth and about global deflation. And, one of the things you might have noted in the past is that Raghuram Rajan has been one of the biggest critics of QE and the fact that all it was competitive devaluation. And when you saw the Fed trying to get out of QE and getting to raise interest rates, it could cause global turmoil. Unfortunately, he's proving to be prescient, quite foresightful again, as he was about the financial crisis. So I think we're in a risk-off mode till we figure out where growth is going and what kind of ammunition global government officials and central bank officials are able to bring to bear to cause the deflationary forces, to abate. And so right now we're in a mode where investors are shooting first and asking questions later in terms of taking risk off.
Okay, Geoffrey, morning to you. What's your call on the U.S. market? Do you think we could be at the beginning of a big bear phase in the U.S. market? Is that your sense? Because the kind of fall that we had last week was quite crunching.
My main focus is, of course, on the emerging markets, but I think your previous speaker was absolutely right. This all began with the Chinese decision to let their currency slide a little bit, because what that did is to raise concerns about global growth, and in particular, of course, about Chinese growth. And I think everything's kind of followed on from there, because that's led to another leg down in terms of the commodities. So I'm a little bit perhaps more constructive than a couple of other your speakers, in the sense that I think that the global economy is perhaps not as weak as some of the recent market movements would suggest, and perhaps to an extent the U.S. sell-off in particular is getting itself overdone at the very least in the short term. In other words, something of an overreaction to the Chinese move. Chinese growth is weak, we know that, but perhaps this is an overreaction to that. And of course, to a certain extent, the concerns about whether the Fed will raise rates in September are also contributing to that. But this has mainly been a global growth scare and we suspect it may be getting a little bit overdone now.
Okay, so this is a global growth scare that is getting overdone. Jeff, hi, morning. You know, until now, every single global fall has been a very good buying opportunity, at least for the investor back home in India. Do you think this time could be the same?
Yes, I think so. Ultimately, when you get pressures that are quite this extreme, it's very hard to know exactly when the bottom will come or when the buying opportunity will come. But in terms of, as I said in my previous answer, in terms of a reaction to a very modest move by the Chinese authorities to try to weaken the currency somewhat, which reflects the concerns over Chinese growth, I think it is something of an overreaction now, and therefore I suspect this decline will blow itself out over the next couple of days, and then we may see at least a near-term buying opportunity. So a little bit of an overreaction, as I say, I think, given where the global economy is. Although, of course, we'd like it to be stronger. The global economy isn't particularly strong. The export side, in particular, is weak in the global economy. But this still looks like something of an overreaction in the short term.
Viktor, right now the sell-off is spread to every corner of the world. In that context, relatively, how does India fare in the emerging market basket?
Sorry, I didn't understand what you said.
No,
you were breaking up.
Okay, I hope my audio is clear now. I just wanted to know how India looks relative to the other emerging markets in this correction that we're seeing.
Well, India remains our largest relative overweight within Asia, ex-Japan. I think India is actually relatively better positioned. And nobody is good, as I said, relatively better positioned. And there are a couple of reasons for that. India is a commodity consumer, not commodity producer. India usually would like to have sort of a Goldilocks between US dollar and currencies as much as possible, to still attract some capital, still have some degree of cyclicality without going stagflationary. And I think in India, at this stage, inflation is unlikely to get out of range and out of bounds. The only negative is earnings expectations and multiples, but multiples don't really matter that much anymore. So I don't really put a very sort of high value on the relative multiples. But having said that, I mean, we are in a position whereby people just looking at the flashes and don't see the pattern. And what I mean by that, they just say, okay, it's to do a reaction to China, or it's a reaction to something else. It is a global pattern. One day it could be China, next day it's Eurozone, the next day there is a little bit of snow in the U.S., the next day it could be Middle East or Ukraine. There is a pattern, and the pattern basically is one of circular stagnation. You cannot accelerate demand, you cannot accelerate investment, and a trade no longer grows. So we actually have a degree of deglobalization occurring. So it's not just China, and it's not just reaction to China, because around the corner there will be something else. It's simply a reflection that we're just growing too slowly, and that gives you the volatility.
Okay, Arvind, comment on that, the point that Viktor was making about, you know, it being a cocktail of bad news globally that's dragging most markets. Is this reminiscent of the situation that we were facing in 2008? And do you see the global equities now move into a big bear phase, or is that fear overstated?
Well, I mean, I think, everything is not going to be a global financial crisis like 2008 was, which was, particularly underlined by the collapse of Lehman and the resultant fallout in global financial assets. So I'm not sure it's comparable. It could be significant if it is not just a growth scare, as one of your other speakers mentioned, but if it is kind of calling into question the very long-term effectiveness of QE, and therefore if global growth, after all this quantitative easing globally, is still proving to be extremely stubbornly low, and deflation is proving to be extremely difficult to kill, then I think it does raise the questions of, have we reached the limits of policy action? If that's the case, then it's a new kind of I think crisis may be too strong a word, but new kind of a headwind for the markets to deal with, which is that U.S. is probably still relatively better off, but global growth looks extremely weak. And I think commodities, and even within the U.S., if you look at some of the sectors like transports and industrials and others, they were all already in a corrective phase before this recent sell-off. So I don't think it's just commodities, but there were other sectors which were giving signals of what are classically considered to be factors that suggest that global growth or even U.S. companies focused on global growth were seeing headwinds. So I think that there are underpinnings here which suggest that global growth is facing question marks, and until we get a clear answer to that, I think markets are likely to stay under pressure.
So Arvind, our market, Indian market, has been a bottom-up stock-picking market this year. Do you think that will get changed if the kind of fall that we're seeing in global market continues, or do you think it still remains that, and maybe not today, but at some point during the week, would it be a good buying opportunity?
Yeah, no, absolutely. I think India remains, in the best of times and the worst of times, a stock-picking bottom-up market. And we are strong believers that companies with good managements, good balance sheets, and growth stories. But again, remember, India is also seeing a lack of growth visibility in the broader economy and in the broader set of companies. But if you can find good companies with sustainable growth, growth is becoming the rare commodity in the world. And India has a good number of really high-quality companies with bottom-up growth stories, and that's what I'd be looking for into the sell-off, finding opportunities to buy stocks that may have run up and gotten expensive, and in this sell-off, if they give opportunity to buy, we are looking to buy the companies whose growth is visible and whose balance sheets are bulletproof.
Jeff, you indicated in your earlier answer that right now the global growth concerns or the scare is overdone, and maybe it's a near-term buying opportunity. So right now you don't expect much of a time or a price correction for the equity markets globally?
No, I think, as I say, I think it's very hard to know where the bottom will be over the next few days. But and as I think all the speakers are agreeing here, this is a significant global growth scare, and that's certainly the point that we're making. I think the point I'd like to make is that I do see this latest very big decline since over the last 10 days, 2 weeks, being tied in with the moves directly, at least linked to the moves in China. And we feel that obviously the Chinese are very concerned about their economy. The growth is not coming through in the way that had been anticipated. But we don't necessarily think this translates itself into a global recession. I mean, if we are heading into global recession, clearly these markets are going to go lower still. I think I'm just saying that we suspect that the global economy, while it's weak, and exports, as I say, in particular, are weak, and we may well be getting towards the limits of what monetary policy can do at this point in time. We just suspect that the global economy is perhaps not as weak as these dramatic declines over the last few days would indicate. And that's my sense in which at some point relatively soon markets ought to be beginning to bottom out. The global economy is not heading into recession as far as we're concerned. I think that's the key point we're trying to make.
All right, so global economy is not heading into recession. Jeff, as you must have heard, both Viktor and Arvind believe that India is, the cleanest shirt, continues to be the cleanest shirt in the laundry basket. In your assessment, which is the most attractive emerging market now for, say, the next 6 to 12 months?
Well, India is certainly one of our favorites as well. We have an overweight in India within our emerging market portfolio. And your previous speakers have said some of the key points here. And we are concerned somewhat by short-term earnings disappointments in India over the last 2 or 3 quarters. And also, of course, the growth of the economy is perhaps not picked up as quickly as some had hoped. We'd always believed that the growth rate, as a result of some of the reforms that are starting to come through and the very good monetary policy that's been followed by the RBI, the growth was going to kick in a little later perhaps than some had believed. So we're not that disappointed by the economic numbers. We are concerned a little bit by the earnings slowdown, but as previous speakers have said, companies are the very good companies in India. You are seeing much better growth than in other parts of the emerging world. Monetary policy is good, and in this environment, it's absolutely true that valuations probably aren't such a handicap as they've been in the past, where investors are looking for places to put their money. We also, at the moment, and that's what I need to talk about here, we also have overweights, and we would be looking to buy China back at some point, in terms of not, of course, the Shanghai Composite Index, but the essentially the H-share index of stocks quoted in Hong Kong. We also like Mexico. We also have some exposure in Central Europe. But it is not an easy time in emerging markets, for sure. And but those would be some of the markets we'd be focusing on.
All right. Jeff, thanks for joining us and giving us your view. And Victor, thanks to you as well. Before I let you go, Arvind, just wanted to ask you your views on, two sectors that have really been the leaders of this bull market, so to speak, the IT and the pharma sector. Do you think there's still more value in this space? One, because of its defensive nature, and two, because of the way the rupee has been moving?
Well, I mean, I think, I would say that the rupee weakness does help, but global growth concerns do hurt. So in that sense, the IT sector is probably a little more at risk than the pharma sector in terms of, one benefit and one negative. So, in a profit-taking environment, you probably see some pressure, although it probably won't lead the way down. But I think the IT sector will probably feel a little more pressure than the pharma sector because, global growth is important to them. And growth in U.S. and Europe are important. So if there are concerns about that, then that could hurt a little bit of the sentiment and therefore the valuation. So I think that these two sectors are clearly beneficiaries of a weaker rupee, but IT probably has a little more of an impact of the growth scare than pharma does.
Okay, and what about the financial space, Arvind? Last week was extremely choppy. PSU banks started off well and then they came in for profit booking, while asset quality concerns continue to remain for the entire sector. How would you approach the financial sector in the coming few weeks?
Well, I mean, I think, we have not been fans of PSU banks for several months now. And I think the market got a little bit euphoric on some announcements last week or by the government about appointment of new CEOs or MDs of some of the banks, as well as some new policy measure outlines and plans to put money in. But I don't think any of these are going to fundamentally change the PSU banks immediately. So I think the PSU banks headwind in terms of non-performing assets is going to continue to remain an issue. And I think the equity issuances that have to be done at extremely low valuations relative to book value. Therefore, they're going to be dilutive. So we think that, again, high quality, this is a market in which when you are uncertain, it is not the time to go down the quality scale. So high quality private sector banks or NBFCs or maybe one or two of the leading PSU banks, like a state bank, if one wants to venture in that direction, that would be the way to go. We would be, much, again, more quality focused and not trying to be value buyers on companies that have a lot of hair in them, and banks would fall into that category.
All right, Arvind, we'll leave it at that. Thank you for joining us. So as you heard, those were some of the most intelligent views coming in on the markets and measured views as well. Yes, we are in a bear phase, but no, this is not a global recession. We'll slip into a short break, and when we come back, we'll talk about the top 10 list of stocks that CNBC TV 18's team is watching out for.